Well, joining us now is economic strategist Dan Varroney, back on the news desk with us, who argues the Federal Reserve should not confuse energy-driven inflation with an overheated economy, and discusses a reported Trump administration memorandum with Iran and how it potentially compares with the earlier nuclear deal. Dan, welcome back to the news desk. Thank you for your time today.
Pleasure to be with you.
So, Dan, you argue that this isn't an overheated economy, but an energy shock. What's the clearest data point viewers should understand that proves that distinction?
So 60% of the inflation that we see today, meaning the higher prices, comes from the higher cost of energy. So what I mean by that is that clearly we see it at the gas pump and we recognize it at the gas pump, but it comes from somewhere else as well. Diesel fuel, everything in this country is delivered somewhere. So food is delivered, all of our other products are delivered somewhere. And the higher price of diesel, the higher price of gasoline have contributed to higher prices across the board. Now that I said that, uh, it's going to be a challenge for a while because it's going to take a long time for prices to come down related to gasoline.
Prices come down. Are we looking at a 6 month slowly price decrease?
No, I don't think we're looking at that. I think already we're starting to see prices come down. I checked the WTI numbers right before we came on air, and they're around $76 a barrel. Here's the issue. The issue is inventory. The inventories here
Hmm.
in the US are way down. The president at his post G7 press conference today indicated that we're about 4 weeks left on our reserve and that globally we're down about 1.7 billion barrels in supply. So we've got to build up the supply. That supply will improve and increase with the Strait of Hormuz opening, hopefully on Friday. And with the supply coming back, oil prices will come down. Now, my expectation is that we'll see gasoline prices come down probably in the fall, in that September October window, close to where they were before the Iran war. But I think if people are waiting for that, I would say closer to Thanksgiving and Christmas to return to those gasoline prices.
Let's talk about the Fed. Critics say holding Fed rates risks letting inflation expectations drift higher. Are they wrong, or is there a middle ground?
So I think the middle ground is as follows. I think that historically, the Fed has always been very responsible when there's been external shocks. Are still in the midst of an energy price shock. Going and imposing higher rates in the middle of an energy price shock, I think could have been disastrous. I mean, let's look at it. Does raising rates increase the fuel supply? The answer is it doesn't. Does raising rates lower prices? It doesn't. Right now, we're in, I think, an incredibly resilient economy. We're seeing employment not only stable, but we've seen considerable job growth since the beginning of this year. Why do we want to put a pin in the balloon of the economy when it's already suffering from an energy price shock?
What's the real world impact of another rate hike on small businesses right now?
I think it would be devastating. Let me give you an important data point. So, in the last set of jobs numbers, now the BLS delivers its job report, and usually 2 days before that, ADP delivers its jobs report. Do you know that almost 70% of the 122,000 private sector jobs created, they came from small business? Small business generates 2 out of 3 uh, new private sector jobs. The last thing we want to do is squash employment by raising rates. The other thing is that we want to be stimulating higher capital investment. We want those small businesses to be investing in new plants and equipment. 99.9% of our companies are small businesses. We would squash them with higher rates. The other thing is the rates are already too high for small business to get loans. They don't have access to affordable capital at this point. Why are we going to make it even more unreachable?
Bottom line, Dan, what's the biggest mistake the Fed could make at this June meeting?
Well, the good news is they didn't make the mistake. They decided to keep rates where they were. And for transparency's sake, I will tell you that I've been arguing for months for the
Hmm.
Fed to cut rates, in large part for small businesses to have access to affordable capital. What they did was the responsible thing, and that's what I said in my op-ed this week, which was to keep rates where they are. They acted very responsibly. I think moving forward through the end of the year, I think it would be a mistake, a serious mistake for small business and the overall economy for them to increase rates. They need to finish the year, let the energy price shock wash itself out of the system, and then they can make decisions from there. I think with Jerome Powell during his 8 years as chair, I found him always wanting to do something. Sometimes it's best to just do nothing.
Okay. Dan, let's switch gears now and let's talk about the Trump administration's memorandum of understanding with Iran. What are you hearing about this memorandum?
So the president in his post G7 press conference spoke more directly to it, and I think that to a very large degree there's concern, and I'm encouraging people to really look at this memorandum of understanding with clear eyes. And what I
Hmm.
mean by that is that it's good that the Strait of Hormuz will be opening and that oil will be flowing. But that 60-day negotiation window is serious business because it all has to do with the nuclear materials and Iran's ability to make a nuclear weapon. I think we don't know what's going to happen, but we need to be clear-eyed about it because if we hit another stalemate, could there be more kinetic military action? The answer is there could be. So I think we need to keep our eye on that. But I think for now, the president indicated that he will sign in the next day or so the memorandum of understanding. It's not much different from the different press leaks that we've heard in the last 2 or 3 days.
Does it worry you that possibly after the 60 days that Iran could charge tankers to pass through the strait?
So it worries me on a few levels, and on the most obvious level. So if they start assessing fees, that's going to increase the cost of fuel, right?
Hmm.
And that's going to be a problem. Now, although 20% of the world's oil comes through there, oil is priced globally and not locally. So that will have an inflationary challenge with it. So that does concern me. And I think that will likely be discussed during the 60-day window.
What do you think are the biggest risks of pursuing an MOU instead of a comprehensive agreement?
So I think the MOU sets the stage for comprehensive agreement. Although it's my sense, realistically, that the MOU will be extended another 60, 90, maybe even 120 days, because I think it's going to be challenging to get both sides to come to terms. But I think as long as both sides are talking, I think that's good news. I think the oil keeps flowing.
Um, could this agreement, I mean, it's going to start lowering gas prices. We already seen that right at the pump nationally. But are the markets too skeptical at this point for the MOU? Are we waiting for the final agreement in 60 days?
I have been pleasantly surprised and honestly shocked with how well the market has done and how well the market is doing. There have been strong earnings across the board. The Mag 7 continue to perform well. And I think we'll be getting, next month, the second quarter earnings. And every expectation is that they will be equally as strong and the market will continue to do well. I think we should keep our eye on the bond markets. Right now, the bond markets are not exploding, past the 5% window. We all keep our and should keep our eye on the 10-year. The 10-year is well under five. I think if the bond markets were going nuts and the stock market was tanking, I think we'd say the market's got a lot of skepticism, but I'm not seeing that right now.
How different is this reported agreement structurally from the Obama era JCPOA?
That is an absolute great question. So essentially, what you had is, first of all, there were direct out-of-pocket cash payments from the U.S. uh, to the government of Iran. There are no direct payments per se. They're allowed to sell their oil if the countries in the Gulf region want to form a reconstruction fund and fund Iran's reconstruction, they can do that. But there's no direct payments per se from the U.S. So I think that's the first difference that I would cite. And the other difference that I would cite as well is that under the JCPOA, under the Obama administration, the Iranians were allowed to keep enriching uranium. And that was dangerous. Uh, what even under the MOU, there's a standstill agreement, and what the president will be looking to do is saying you're not going to have nuclear weapons at all. So I think those are distinctions and differences.
Okay. If you step back, is this more about economics, politics, or global security, or are all three of them inseparable?
So I think they're all inextricably linked. Make no mistake about it. And oil is on the global chessboard, right? Oil drives everything. We know that, and we knew that coming in. So I think at the end of the day, they are all inextricably linked. But I think global security, national security are tantamount. I think economic security is equally as tantamount. I think what the MOU does is it gets both sides talking. It gives us all the ability to take a deep breath. It allows oil prices to come down. It allows our economy to return back to some degree of normalcy. It will lower our prices. I expect food prices over the next 90 plus days to come down. I think our holidays, meaning the Thanksgiving, Christmas holidays, from a food price perspective, if the MOU process goes well, the food prices will look as good as they did pre-Iran war.
We have a very strong relationship with Israel. Could that be a kink in the armor for us if Lebanon and Israel continue their tit for tat?
The president was explicit today in his post G7 press conference, and I think it's absolutely right. No one country, meaning Lebanon, or let's say an Iran proxy, meaning Hezbollah, or Israel, should overreact. Uh, and I think the president indicated that Israel, especially, should not overreact to any incursion or to any bombings. That it should
Mhm.
be proportional in nature. And the president is saying that because he doesn't want the negotiations to come undone.
We're currently seeing Vice President Vance out front and center on this, especially with the signing of the agreement. Um, is if this agreement doesn't work out to where maybe your Republicans or a lot of Americans agree with this new MOU, is he being set up for possibly the fall guy?
I don't view it that way. I honestly don't view it that way. I think the president knows he's the commander in chief. He's the person in charge. And whatever way it goes, the president is going to own the good, the bad, and the ugly. And I think the president is confident at this point that he's going to be able to navigate this to uh, the right conclusion for global security, for domestic security, and for the economy.
Yeah, I guess I just threw that out there, Dan, is because all good news. President Trump always likes to be a part of good news. He likes the signing
Sure,
ceremonies,
sure,
and he's
sure.
somewhat in the region. He's in Europe right now with the G7,
Yes.
so I mean, it wouldn't be too far for him to go.
So I think that he may be a part of the signing ceremony or he may not. But I think the administration in total will own success or failure. There's no other way around it.
Hmm. For everyday Americans, Dan, watching this, what's the key signal they should be paying attention to in the weeks ahead?
So there are a number of key signals. They need to keep their eye on employment. I think, is employment going to stay steady? I have every hope, and the data says it will stay steady. They need to keep their eye on clearly gasoline prices and food prices. We should all be keeping our eye on credit card defaults, on mortgage defaults, on auto loan defaults, and make sure they don't get out of control. So those are the things beneath the surface that we may not always hear about, that we should keep our eye on. I think if they stay under control, I think that's good. But I think there's something else. And the something else has to do with housing and affordable housing. An interesting data point. I happened to get a copy of a report coming out of the National Association of Home Builders, and there's been a lot of talk, as you know, around affordable housing and new housing. And I learned that every new house that is built here in this country costs $131,000 in regulatory compliance fees. $131,000. That's from the local, county, state, and federal government. That's the cost of compliance. So that's what builders are having to contend with. Yes, land prices are high, but those regulatory prices are high. So there needs to be a coming together of local government, state government, and the federal government in figuring out what can be done on regulations. And look, nobody is saying get rid of regulations, because we know regulations are necessary for safety and safe home building. But what needs to happen is there needs to be a rational approach to regulations so people aren't blocked out of the market by the high cost of regulations. So when you take the high cost of regulations and now high mortgage rates, I mean, that's one of the key answers to, affordable new houses.
Well, I'll tell you one thing, Dan, that people are going to keep their eye on. It's that reflecting pool in Washington, D.C., to see if it can get any greener.
Yes, yes, yeah. It's
Dan?
I get downtown every so often, and it's look, I get it.
Yeah. Well, Dan, thank you so much. I sure appreciate visiting with you, sir.
It's a pleasure. Always a pleasure to be with you.
Talk to you again soon. All right.